Hi everyone, this is Eric Rodabois, 5 Minutes with Eric, EPGD Attorneys at Law PA. Sunny Miami, Florida. I was up at our DC office yesterday, and actually while I was there I took a call, a new client. Unfortunately, it's an old story, okay? So if you are a business owner and you have employees, you cannot delegate the responsibility of collecting the taxes and paying it over to the IRS. So let's just talk through this for a second. The client is a small business owner, happens to even be a lawyer, owns a law firm, okay? Has 3 or 4 employees, a paralegal, an assistant, an associate, and they thought they were doing everything right. They have a bookkeeper that does QuickBooks for them and comes in once a month and makes sure that everything's all organized. They have an accountant who prepares the tax returns. They have a payroll company that's handling the payroll. And when you hire a payroll company, what they do is they do the math. They withdraw the taxes, they take out the pay, and then they direct deposit it into the employee's account. And then what they're supposed to do is also prepare these tax returns. They're called 940, 940, and 941. And these go to the IRS with a reporting of here's the employees we had, here's how much we withheld from their paychecks, and here's how much money we're sending you, IRS. So just to think about it for a second, when you're an employer, a couple things happen when you have an employee. Number one, you take out 7.5% from the employee's paycheck to pay for Social Security, Medicare, and federal unemployment tax. And then you put in 7.5% of your own money. So if I pay Lorena $100, it's really $107 to the company, okay? So now I've got about $15 on Lorena's behalf going for Social Security, half from me, half from her. That's the first part. Second part is we do estimated tax payments, because what happens is when everyone goes and pays their taxes in April, if it was up to them to save all year, nobody would pay over, and the IRS figured this out a long time ago. So what they do is they force the employers to do withholdings. All a withholding is hey, employee, I don't trust you to be responsible enough to pay the IRS when your taxes are due, so I'm going to go ahead and take them myself for the IRS, and then every quarter I'm going to pay them over. The IRS credits that to the employee's account, and then in April the employee goes and files a tax return with the W-2 from the accountant saying how much money they made, how much was withheld, how much went to Social Security. All those numbers are supposed to all match up, and then it goes to the IRS, and then that's why a lot of times people get a refund. You get a refund because you've already been paying all year round, and maybe you overpaid because there were deductions or whatever reason. Okay, so going back to my client. My client thinks they're doing everything right. And in fact, they have not an idea in the world that anything's wrong until they get a letter from the IRS. And the letter goes something like this. Dear taxpayer, you failed to make the payments for your employees for third quarter 2017 and fourth quarter 2017, because that's the way they do it, by quarter. And so she goes to the bookkeeper, and the bookkeeper blames it on the payroll people. She goes to the payroll people blame it on the accountant. They go to the accountant, and the accountant blames it on her and says that, oh, well, you should have known better, which is kind of true, okay? You cannot tell the IRS, oh, sorry, I forgot to pay everyone's employment taxes because I hired all these other people and they screwed up. Now, I'm not saying we don't have a claim for malpractice or negligence against those other people, those professionals that we hired, and we paid them good money and told them to do their job, but it's still your fault. So you need to be looking at your bank statements. Once a quarter, you need to be aware that there should be a payment going to the IRS for all those taxes that you should have been withholding. And if you look at your bank statement and you don't see a payment to the IRS, something's wrong. Now, the trick is if you catch the problem soon enough, maybe you can avoid the penalties, and certainly you can reduce any interest, because that's the way it works. They apply penalties because what they want to do is they want to slap everyone on the wrist to make sure that they don't make the same mistake twice. The IRS essentially, doesn't have enough employees to regulate all of the tax collecting across the country. So what they do is they deputize, if you think about it, they make every employer in the United States work for the government. And what's the penalty if I don't work for the government? Penalties and interest. Okay, so penalties and interest, it adds up real fast. In this case, there's about $5,000 in taxes that weren't paid on behalf of those employees, and about $6,000 in penalties and interest on top of the $5,000. So the company, the law firm, is looking at an $11,000 tax bill on $5,000 that she thought she had already paid to the IRS, and not only that, but on the employee's pay stubs, it showed it as being withdrawn. So I said, listen, let's get on a payment plan, let's ask the IRS to abate the penalties, and then let's fire the accountant, the bookkeeper, and the payroll company, and let's sue them all. but that's just me. So thank you, everyone. Eric Rodobois, EPGD Attorneys at Law.